On the afternoon of May 6, 2010, Wall Street was preparing for another ordinary trading day. But within minutes, the market's calm turned into absolute chaos. Volatility was already present, with nervous investors reacting to a series of uncertain economic news. What no one expected was that this day would become one of the most memorable in financial history, marked by an event that would last only 36 minutes. The first signs that something was wrong began to appear around 2:32 p.m. The stocks of large companies started to drop drastically, but the reason was still unclear. An insane number of sell orders began to flood the market, and within minutes, stock prices started to plummet. What seemed like a simple correction quickly turned into an unprecedented collapse. At the epicenter of this panic was the company Procter & Gamble, which saw its shares plummet to an unreal price. In a move that defied logic, the shares tumbled from $60 to under $40 in seconds. What was happening? The answer would become evident as the collapse unfolded. The automated trading mechanisms, which many regarded as an innovation, were turning into an uncontrollable monster. These systems, programmed to respond quickly to market changes, were exacerbating the situation. The sales became a chain reaction. As prices fell, other algorithms kicked in, selling as well to avoid larger losses. The result was a downward spiral that seemed to have no end. The Dow Jones, which was on the rise, found itself dropping by over 1,000 points in such a short period. This was one of the largest single-day declines in the index's history. Fear took hold of the traders, and panic spread quickly among investors. Trading systems began to fail. Exchange platforms were overloaded, and orders were not being processed as they should. The lack of liquidity became a critical issue, as people desperately tried to sell their shares, but there were no buyers available. This created a surreal scenario where stocks were traded at ridiculously low prices, while the real value of the companies was ignored. By the end of the 36 minutes, the market began to stabilize, but the damage was already done. The Dow Jones had lost almost 10% of its value in the blink of an eye, and investors' confidence was severely shaken. U.S. financial authorities launched an immediate investigation to understand what had happened. The collapse was not just an isolated event, but rather a warning about the fragility of the global financial system. The flash crash of 2010 raised crucial questions about market regulation and the effectiveness of automated systems. The event showed that, despite advanced technologies, the market was vulnerable to irrational and instinctive movements. The lessons learned that day still echo in discussions about financial market safety, reminding everyone that, in a world where speed is everything, a small error can trigger a major disaster. The flash crash was not just a market drop. It was a manifestation of the fear and uncertainty that permeate the financial world. It served as a grim reminder that in a matter of minutes, confidence can be destroyed, and what seems safe can become a deadly trap. The legacy of this event is still felt, as investors and regulators continue to work to ensure that the mistakes of the past are not repeated. After the flash crash, the landscape in the financial world changed. Alarmed by the speed and intensity of the drop, American authorities took immediate measures. The Department of Justice and the U.S. Securities and Exchange Commission (SEC) initiated detailed investigations to understand the underlying causes of the collapse. The goal was to discover whether there was market manipulation, if automated systems were inadequately programmed, or if lack of oversight contributed to the chaos. The investigations revealed that the complex interaction between trading algorithms and market liquidity shortage were critical factors. Many investors wondered if the increasing use of algorithms was actually creating a more volatile environment. Algorithms were designed to respond quickly to price movements, but this speed often resulted in mass selling, exacerbating the decline. One of the main findings was the relationship between liquidity and volatility. During the flash crash, liquidity disappeared rapidly. With the panic selling, many buyers withdrew from the market, leading to even lower prices. This lack of available buyers caused stocks to be sold at much lower prices than their actual values. The market crash became a clear example of how the lack of liquidity can turn a market correction into an epic disaster. Another issue raised was the effectiveness of the existing rules on high-frequency trading. Regulators began to question whether the safeguards in place were sufficient to prevent harmful behaviors. The flash crash not only exposed vulnerabilities in trading systems, but also highlighted the need for stricter regulation. In response, the SEC began proposing new rules to increase transparency and oversight in the market. One of these proposals was the implementation of a circuit breaker, a mechanism that temporarily halts stock trading if prices fall or rise by a significant percentage in a short period. The goal was to prevent a situation like the flash crash from recurring, providing a pause for traders to assess market conditions before resuming trades. Furthermore, the event led to broader discussions about the nature of the modern financial market. With the growing reliance on technology and algorithms, many investors began to question whether machines were truly more reliable than humans. The idea that automated systems could make financial decisions better than experienced traders was challenged. The flash crash demonstrated that, in stressful situations, algorithms could act unpredictably and cause disastrous results. The impact of the flash crash was also felt by small businesses and individual investors. Many faced significant losses, and confidence in the financial system was shaken. For the average investor, who often relies on solid information and analysis, the event was a painful reminder of the market's vulnerability. The perception that large financial institutions and high-frequency traders had an unfair advantage increased public distrust. Over time, the 2010 flash crash became a case study in business schools and finance courses. Teachers and experts analyzed the event to better understand market dynamics and the risks associated with automated trading. The lessons learned have influenced the formation of new generations of financial professionals who now approach the market with a more critical perspective on the risks of high-frequency trading. Financial regulators have continued to work to implement the lessons learned, but the legacy of the flash crash persists. The event not only changed the way markets operate, but also inspired a wave of innovations and debates about the future of trading. Issues of ethics, transparency, and responsibility in the use of algorithms remain relevant. The idea that technology can facilitate but also complicate market dynamics is a constant concern. As innovations continue to emerge, the need for effective oversight and adaptable regulations becomes increasingly clear. The challenge is to find a balance between innovation and security, ensuring that technological advances do not jeopardize the stability of the financial system. In a world where speed is fundamental, the flash crash of 2010 serves as a warning. It shows that even in an environment filled with advanced technology, market fragility can be exposed in an instant. As the financial market evolves, continuous vigilance and adaptation to new realities become crucial to prevent history from repeating itself. The response to this historical event is not just a matter of regulation, but also of collective responsibility. All market participants, from individual investors to large financial institutions, must be aware of the implications of their actions. The flash crash was not just a technical failure. It was a call to reflect on how to navigate an increasingly complex and interconnected market. As the years go by, the flash crash of 2010 continues to be a reference point in discussions about financial stability and market security. The legacy of this event, with its lessons and challenges, remains relevant, reminding everyone that in a constantly changing financial world, caution and responsibility are essential. The repercussions of the 2010 flash crash were not limited to the day of the event. Its consequences extended over years, shaping the future of the financial market. Authorities and regulators, aware of the fragility of automated systems, began to implement significant changes. The post-crash scenario required a critical analysis of trading practices and the structures that sustain financial markets. One of the first responses was the review of guidelines on high-frequency trading, HFT. While this trading method had the potential to increase market liquidity, the failures exposed during the flash crash raised questions about its safety. The SEC began to require greater transparency from companies involved in HFT, requesting detailed reports on algorithms and their operations. This increased oversight aimed to ensure that trading practices not only complied with regulations, but also did not compromise market stability. Additionally, the implementation of the circuit breaker became a priority. This mechanism, which temporarily halts trading in response to extreme price movements, was seen as an essential measure to give traders time to assess the situation. The goal was to prevent panic from spreading rapidly, allowing investors to reconsider their strategies before taking action. The preventive impact of the circuit breaker was tested in subsequent situations, and its effectiveness helped restore confidence among traders. The importance of financial education also stood out after the flash crash. With the increasing complexity of the markets, there was a demand for greater understanding among individual investors. Financial institutions began offering educational resources, webinars, and courses on the risks associated with automated trading. The focus was on empowering investors to make informed decisions, helping them understand how algorithms work and how these systems can impact their trades. However, the changes were not just reactive. The flash crash opened the door for innovations in the way markets operate. New technologies were developed to improve the safety and efficiency of trading. Trading platforms began adopting real-time monitoring systems capable of detecting anomalous behavior and intervening before chaos ensued. Artificial intelligence also started being used to predict market movements, helping to mitigate risks. The lessons from the flash crash also inspired a broader dialogue about ethics in trading. The idea that algorithms could be programmed to exploit market vulnerabilities raised questions about responsibility. Regulators began to consider not only the effectiveness of rules, but also the ethical principles that should guide the use of technology in financial markets. Transparency and accountability have become central pillars in discussions about the future of trade. Additionally, the impact of the flash crash has extended to investor behavior. Many began to question the effectiveness of their strategies in the face of the new market reality. The fear of a repeat collapse led to a more cautious approach, with many investors opting to diversify their portfolios and avoid excessive concentrations in volatile stocks. This shift in mindset reflected a recognition of the need for resilience in an increasingly unstable financial environment. The flash crash of 2010, therefore, was not just an isolated event, but a watershed moment that altered the dynamics of the markets. The interconnection between technology and finance, now more evident than ever, required a continuous reassessment of trading practices and regulations. As the financial market adapts and evolves, the legacy of that day remains a reminder of the importance of prudence, ethics, and responsibility in the financial world. The lessons learned continue to inform the development of policies and practices aimed at protecting both investors and the integrity of the global financial system. Before you leave, do two things now. Take a deep breath and hold on to what touched your heart today. And, if it makes sense, share this story with someone who also needs to hear it.